Welcome to the Deep Dive. Today, we're getting into the weeds on American Outdoor Brands, ticker AOUT, specifically their first quarter results for fiscal 26.
Right. We'll look at the numbers, sure, but also, what management's saying and what it might actually mean going forward.
Exactly. So let's start with those headline figures from Q1. What jumped out immediately?
Well, the GAAP EPS, earnings per share using standard accounting, was negative 54 cents. Flat compared to last year.
Okay, flat. And the non-GAAP number, the one analysts tend to focus on more.
That came in at negative 26 cents, which actually was just a penny below what people were expecting. So negative 25 cents was the estimate. Pretty close there.
Okay, so EPS wasn't the huge shocker then. What about revenue?
Yeah, that's where things looked quite different. Revenue was $29.7 million.
$29.7 million, and the estimate was?
Around $36 million, so a pretty significant miss.
Yeah.
And that $29.7 million, that's down almost 28.7% from the same quarter last year.
Wow, okay, 28.7% down year over year. That definitely gets your attention, and I imagine the market reacted to that.
Oh, absolutely. Shares took a pretty big hit in after-hours trading.
Yeah.
You saw immediate concern about that top-line number and the outlook they gave too.
Yeah, that kind of drop, you'd expect that reaction, but as we often find in these deep dives, the headline doesn't always tell the full story, does it?
Not at all, and this is a classic case, really. Management had a very specific explanation for that big revenue decline.
Okay, I'm intrigued. What was their take on why sales dropped almost 30%?
So they pointed to something they called a pull forward, basically about $10 million worth of orders that they expected to land in Q1. Actually got booked in the last 3 weeks of the previous quarter, Q4 of fiscal 25.
$10 million pulled forward. Why would retailers do that?
Tariffs. It seems retailers were trying to get ahead of potential price increases linked to those high tariffs on goods coming from China. They wanted to lock in orders before prices potentially jumped.
Okay. So it wasn't that demand suddenly vanished in Q1. It's more like Q4 got artificially inflated and Q1 then looked artificially low because of that shift.
Exactly. It's a timing issue caused by external factors, not necessarily a reflection of underlying consumer interest dropping off a cliff.
Right. That completely reframes that 28.7% decline. So if you mentally add that $10 million back into Q1, what does the picture look like then?
Well, doing that math on a sort of like-for-like basis, adjusting for those orders, the Q1 net sales decline would have been much smaller, only about 4.7% year over year.
Only 4.7% down instead of 28.7%. That's a massive difference in perception.
It is. And it gets even more interesting when you look just at their traditional sales channel, like brick and mortar retailers.
Okay.
If you adjust that channel for the pull forward, sales would actually have been up approximately 15% year over year.
Up 15%. Wow. Okay, so underneath all that noise about tariffs and timing, the core business with traditional retailers seems pretty healthy then.
It definitely suggests a stronger underlying pulse than the headline number implied. You've got this tension between what consumers seem to be buying and how retailers are managing your inventory and ordering.
Fascinating. Okay, so revenue adjusted looks much better. What about profitability? Did those softer reported volumes hurt their margins?
Surprisingly, no. Well, maybe not surprisingly given their focus, but gross margin actually went up. It expanded by 130 basis points, so 1.3 percentage points, reaching 46.7%.
Higher margins despite lower reported sales. How do they manage that?
Seems like a combination of things.
Yeah.
Proactive supply chain work, maybe some strategic pricing, and importantly, keeping up the pace with new products. New innovative stuff often carries higher margins.
Right. Makes sense. And the balance sheet, how's that looking?
Still very solid. They ended the quarter with $17.8 million in cash and crucially, zero debt.
Zero debt is always nice to see. Gives them flexibility. Were they using any of that cash? Any buybacks or anything?
They were. Yeah, they brought back about 240,000 shares during the quarter. Spent about $2.5 million on that.
Okay. At what price were they buying back?
Average price was $10.47 per share. And they still have about $4.66 million left on their current buyback program, which runs through September 2025.
Interesting. Buying back stock around $10.50. We'll come back to that later. What about inventory? Did that move much?
Inventory did go up, yeah. Ended at $21.1 million.
Yeah.
But they said that was largely intentional building up for the hunting season and the holidays. Plus, holding some extra stock strategically because of all the tariff uncertainty and potential shifts in where they source products from.
Okay. Seasonal build plus a bit of a buffer stock. Makes sense. Any big capital spending?
No, pretty minimal, just $370,000 in CapEx, mostly for things like tooling for new products and patent costs.
Got it. You mentioned new products helping margins. How significant are new products for their sales overall?
Pretty significant. They accounted for 29% of net sales in Q1.
Nearly a third. Wow.
Yeah. And management specifically highlighted a couple, like the Caldwell ClayCopter sounds fun and the BUBBA Smartfish Scale Lite. They said these kinds of innovations are driving, quote, stronger POS versus peers.
POS meaning point of sale. So what's actually selling through at the retail level?
Exactly. It suggests that even if retailers are being cautious with orders, consumers are actively buying AOUT's new innovative stuff. That innovation isn't just about flashy features. It's core to their strategy to, cut through the noise and focus on those higher margin items.
So innovation is key. Are they looking at other strategic moves beyond just physical products, anything longer term?
Yes, definitely. A really interesting one is their expanded partnership with Major League Fishing through their BUBBA brand.
Okay, what's happening there?
They're launching something called SCORETRACKER Live within the BUBBA app. That's planned for spring 2026.
ScoreTracker Live, what is that exactly?
Yeah. It sounds like a feature that will likely offer real-time scoring or tracking for fishing tournaments, integrated directly into their app. But the key strategic point is, it's expected to be a subscription service.
Recurring revenue. That's the magic phrase.
Precisely. It marks a potential shift for them, moving from just selling, knives and scales, towards a model that blends products with services. The aim is pretty clear. Create a more predictable, less cyclical revenue stream over the long haul.
That could be a really smart move to smooth out those seasonal bumps we see in the outdoor industry. Okay, so looking ahead then, what did they actually guide for? You mentioned the outlook spooked the market a bit.
Right. So for the next quarter, Q2 fiscal 26, they expect net sales to be down again year over year by about 15%.
Down 15% for Q2. Okay. What about the full year?
They decided not to give full year guidance.
Why not?
They pointed to the ongoing uncertainties. The tariff situation is still fluid and retailer ordering patterns are still pretty choppy, kind of stop-start.
So too much unpredictability right now to confidently forecast the whole year.
Seems to be the case. But, despite acknowledging those near-term headwinds, management sounded pretty optimistic about the year overall. They kept highlighting the strong point-of-sale data and their new product pipeline.
And longer term, what's their target for profitability?
They reiterated their long-term operating model goal, which targets a 25-30% contribution from EBITDA that's earnings before interest, taxes, depreciation, and amortization, a key profitability metric.
Okay. Let's circle back to those tariffs and retailers, because that seems absolutely central here. How exactly have they been navigating this tariff roller coaster?
Yeah, it sounds like it's been challenging, a real moving target. Remember, late last fiscal year, tariffs on some Chinese imports apparently spiked as high as 145%.
145%? Wow.
Yeah, so AOUT actually paused inventory purchases then. But when those tariffs got lowered back down to 30% early in Q1, they started buying again.
So they're actively managing purchasing based on those rates. Are they shifting production out of China?
They're trying. Shifting some production to other countries where it makes sense. But they also admitted that for certain, really specialized high-tech products, China is still the most competitive place to get them made.
So it's a balancing act.
It is. Their priorities seem to be, first, don't compromise product quality. Second, protect those gross margins we talked about. And third, just keep the supply chain flowing. They're using a mix of tactics, sharing costs with suppliers, adjusting prices strategically, maybe even redesigning some products.
Okay. And on the other side of that coin, the retailers and consumers. We heard POS is strong, especially for new stuff, but retailers are cautious. Can you elaborate on that disconnect?
Yeah. Management believe their brands, especially the premium ones, appeal strongly to sort of two groups. More affluent consumers who aren't as price sensitive, and the real super enthusiasts who want the best gear regardless. That's where they're seeing strong POS.
But the retailers aren't ordering consistently based on that.
Apparently not always. Retailers seem very focused on managing their own working capital, maybe worried about getting stuck with too much inventory if the economy slows or tariffs change again. So they're ordering in bursts, turning the taps on and off.
Creating that mismatch between final demand and wholesale orders.
Exactly. And management also mentioned observing that maybe lower to middle income households are pulling back a bit on spending, which affects general store traffic. But they feel AOUT doesn't really play much in those lower opening price points anyway.
Interesting. So their target customer might be more resilient, but the channel they sell through is being cautious. What about e-commerce specifically? You mentioned that channel underperformed.
Yeah, direct e-commerce sales were down 35.2% year over year.
That's quite a drop. Why?
It sounds like it was mainly driven by one particularly large e-commerce retailer changing its buying patterns, likely also related to those tariff impacts and inventory management.
So one big customer pulling back significantly skewed the channel's overall number.
It seems that way. And interestingly, management also suggested that traditional retailers are actually seeing their own e-commerce sales increase. So people might still be buying AOUT products online, just perhaps shifting where they buy them online, maybe from the big e-tailer site to the traditional retailer site instead.
Okay, so the channel definition might be blurring a bit there too. Given all this complexity, tariffs, retailers, demand signals, strategy shifts, what are the absolute key things investors should watch over the next few quarters? What are the catalysts?
Okay, I'd say number one, how does Q2 actually shape up against that negative 15% guidance, especially leading into the holidays?
Right, performance versus guidance.
Number two, any clarity on tariffs? Does policy stabilize? And how does AOUT continue to adapt its sourcing and pricing? That's huge.
Tariffs, got it. What else?
Third, watch that point of sale data. Does it stay strong? And do they keep up the pace of innovation? That proves their core strategy is working with consumers.
Sustained POS and innovation. Makes sense.
And finally, that longer-term catalyst, the ScoreTracker live launch in spring 26. Watch for execution there. Does it launch successfully? Do people subscribe? That's key to their whole products plus services diversification plan.
Okay, so Q2 results, tariff stability, peace innovation, and the ScoreTracker launch. And overarching all that is navigating that tension between consumer pull and retailer caution.
You nailed it. That's the core challenge and opportunity right now.
All right, fantastic breakdown. That brings us to our This Is Not Financial Advice segment. We take everything we've just discussed, the numbers, the narrative, the nuances, and propose one, let's say, bold but plausible trade idea for you to consider.
Okay, so the market hammered the stock after hours, right? Down almost 18.5%.
Yeah, big reaction.
But we just unpacked why that headline revenue number was maybe misleading. Adjusting for the pull forward, sales weren't nearly as bad, and traditional channel was actually up, margins expanded, balance sheet is clean, no debt.
And management was buying back stock above $10 while it was trading closer to $8.50 after hours.
Exactly. So putting all that together, a bold, but I think plausible idea could be this. Consider going long AOUT.
Right.
Specifically, maybe looking at out-of-the-money call options, perhaps with a 6 to 9 month expiry.
Out-of-the-money calls. Okay, explain the thinking there. Why options and why that time frame?
Well, the market seems to have overreacted purely to the headline miss, ignoring the context of the pull forward and the underlying strength in POS and margins. If, and it's an if, tariff clarity improves, or if retailers simply have to restock because consumer demand stays strong, you could see a pretty sharp bounce back in the stock price, a mean reversion, basically.
Okay.
Call options give you leverage to that potential upside. If the stock does recover and re-rate higher over the next, say, 6-9 months, covering the next couple of quarters and maybe getting closer to that ScoreTracker launch news, the options could provide a significant return.
And the downside?
The downside is limited to the premium you pay for the options. So it's a defined risk way to play for a potential recovery, based on the idea that the market overshot to the downside on the initial news. Plus, management themselves are investing in the future with ScoreTracker and buying back shares.
Right, so the thesis is market overreaction, underlying fundamentals better than a headline suggest, potential catalysts on the horizon, and a defined risk way to play for a rebound.
That's the logic. Bold? Yes, given the initial drop, but plausible if you buy into management's explanation and the underlying data points.
Okay, there you have it. A deep dive into American outdoor brands Q1. It really is a tale of two narratives, isn't it? The jarring headline numbers versus a more resilient underlying story shaped by tariffs and timing.
Absolutely. Reported miss, yes, but softened significantly by that order pull forward. It highlights strong consumer demand sort of fighting against cautious retailers and that whole shifting tariff landscape.
And the strategic moves, focusing on innovation, managing the supply chain, and especially that pivot towards recurring revenue with ScoreTracker Live, those are the things to watch to see if they can build more stability.
Definitely. Near-term uncertainty is undeniable, but the long-term vision seems focused on smoothing things out and diversifying how they make money.
Well, remember, everything we've discussed here today is purely for informational purposes. It is definitely not financial advice. Please always do your own research before making any investment decisions.
Absolutely.
For you listening, maybe the thought to leave you with is this. How much weight do we give that initial headline number versus the story underneath, especially in volatile times? What gets missed when the market reacts first and asks questions later?
Good question.
Thank you for joining us in the deep dive.